please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me Anuj and Sonia. Well, we played all those bites because it's been a long weekend and so much has happened over the long weekend. Any other time, a national reporting authority, a regulator auditing auditors is very good news for the macros. It cleans up the corporate reporting system. Any other time, the ruling party returning with such a huge victory in the northeastern states and thereby even removing the image that it only represents Hindus or only represents the North Indian belt would be a very big boost to the market. But unfortunately, both these very significant macros for the economy, for the corporate sector and for the polity is coming at a time when on Friday we had this big announcement of initiation of a tariff war by President Trump. The US markets lost hugely on Thursday, barely made it up on Friday. Europe has been losing for 2 days in a row. Asia has been losing for 2 days in a row, and we will have to pay that price as well. I mean, already the market is discounting bad news more than good news. So today, clearly, Trump will trump the Indian positive macros.
Hi, good morning, Lata. Good morning, Anuj. Thankfully, we were not open on Friday, right? Otherwise, we would see that big fall reacting to that news flow. In terms of a reaction, I mean, the US historically has always stayed away from talking about a tariff war or a trade war. This time around, since that's happened, what would the effect be? I mean, of course, it's too soon to tell, but there will be an adverse effect across economies,
we've
right?
already got statements coming in from Europe and from China saying that they're not going to take it lying down. And there are obviously products from the US which have a huge market in Europe and which will be targeted. The net result of all this could be higher prices, lower productivity, and therefore lower growth. I mean, the global markets are running on the fuel of higher growth, and that will be the casualty, but not the immediate casualty, which is why you may see markets perhaps taking it in their stride now, but if it continues, it's going to be a niggling worry this year.
Okay, Anuj, morning. What's the sense about the market itself? Do you think that all of these factors that we just spoke about could impact the sentiment in the market?
Morning, Sonia. You know, I would make a point here. Though we were closed on Friday, I think time has now come. We've always been talking about whether at least the index should be trading.
Allowed to trade.
You can't have, you know, a 3-day hiatus. And especially in a 3-day where, you know, you have so much news flow, both domestic and global. You know, on one hand, you're talking about aligning yourself to the global market. Extension of trading hours, I think this is important. You know, you should have index which should be trading at least on long weekends. On Friday at least it should be trading. It should be aligning, because on Friday the SGX Nifty was down almost 200, you know, almost down to 10,300, sub 10,300, and then it's recovered. So it's good to say that, you know, for the bulls it was good that it you know, these things actually distort market equilibrium. So in that sense it would be good. And for example, you know, the Northeast elections, that was an important event, and if it's happening on weekend, let the market react to that. But look, my point here is that I think today is not a good day to take a short position. Today might be actually a good day to just try a long position, because you know, you saw that SGX Nifty going to 10,300. From there it's recovered. Of course, it's still showing 10,340, which means we're still staring at 100-point gap down. You know, normally in our market, if you have 100-point gap downs, they don't have follow through, and the risk reward is not in your favor to short at 100-point gap down. Maybe you short if the market starts to recover after that. But this BJP win in Northeast, I think that's important, because while it's only 5 or 6 seats in the Lok Sabha, it's important.
Changes the image of the party.
Exactly, and from, you know, Rajya Sabha arithmetic gets impacted. Also, 2019 becomes an important point to ponder over. The only problem is that we have one large set of investors who's just selling. Even though Thursday there was a bit of buying from FIIs, that's not a trend reversal. Look, you can't just keep on selling, you know, without impact. You can only sell limited number of stocks in Indian market, because otherwise there's no buyer, right? So obviously there's some buying, then immediately selling returns. As of now, my base case is that 10,276 on the Nifty remains sacrosanct, and Nifty has some legs like IT which are helping the market. The bank Nifty is precariously placed because we are right now at 24,900 thereabout, 24,900. The Feb low was 24,780, and the 200-day moving average is 24,730. So let's see how things move from here. This, of course, fears of a US-led trade war has put a fresh risk on table. Yeah. We didn't know about something like this could come on board. But my base case is after a 100-point gap down, do you want to short, or do you want to see the market seeing at least some bit of bounce and then second round of weakness? That I think is the call that you need to take. But on the Nifty, at least you have a sacrosanct stop somewhere around the 10,270 mark.
Okay. No, I'm not in any position to speak about today and tomorrow. Yeah. But I'm just telling you that the manner in which the Trump announcements have come, it has made metals weak. Okay, at a time when the dollar is weak. Normally when dollar is weak, metals strengthen. But today metals are weak and dollar is weak. So metals will not help. IT, again, because dollar is weak, and there are a couple of economists, when I told them this, they vociferously agreed that many of these statements come from the United States, and economists don't oppose it because it helps to weaken the dollar, and that is to their advantage. So this is, probably, helping the US in another fashion, not necessarily by higher tariffs, but by keeping the dollar weak. The weakness of the dollar will again not help IT companies. It will mean a stronger rupee. So that's not going to be to their advantage. So today, while, the metals, the banking sector will not help, these two which are otherwise propping us up are not in the best of positions to provide a counter. And banks, we are always forgetting, we got taken away by the fraud which was announced on February 14th morning. We forgot that February 12th night, the Reserve Bank came with a huge circular which is going to mean that, 70% of the banks are going to report red on their balance sheet when the March results come. And that is why is ICICI falling for a fraud in PNB? I mean, for that matter, even HDFC Bank is falling, but that's another matter. The point is, there is a huge NPA worry, recognition and provisioning that is also hitting. So at the moment, none of the big guys are looking like in a position to take leadership.
Okay, amidst all the gloom, there is one bright spark, which is the domestic auto sector has done pretty well this time, especially the two-wheelers and the tractor makers. So we'll talk about all that in greater detail through the course of the show. First, let's take a look at what our wise experts have to say as we head into trade this Monday morning. Lawrence Belanco, the best and brightest of the minds in the technical space, Lawrence Belanco of CLSA, continues to expect the remainder of this year to be highly volatile and trading-oriented on the back of this growing selectivity. On the macro side, he says this week they've seen the US dollar index complete a short-term basing pattern, which implies a rebound back to the 2017 breakdown area where they would be sellers of the dollar. In addition, Lawrence sees signs of maturity in the US 10-year yields advance, which sets it up for a pullback to the 2.61 to 2.62% area.
Okay. More equity opinion coming your way. Mahesh Nandurkar of CLSA says their analysis of 21 mid-cap schemes revealed the proportion of mid-caps has risen from 43% at end October to 50% at end January, or a near $700 million allocation change. He says more adjustment would have happened in February. Also, he estimates over the next 3 to 4 months an additional $0.7 to $1.2 billion of allocation changes will be needed, which should support mid-cap performance. CLSA's preferred mid-caps are Godrej Properties, Prestige, Crompton Consumer, Astral, Poly, Supreme Industries, Arvind, Jubilant Food, Emami, Torrent Pharma, Polo Hospitals, Tata Power and IGL. That's an interesting observation, actually.
Okay, well, it's going to be interesting to see how the money market reacts to the big fall that we've seen in the dollar because of the tariff war talks from Donald Trump. Pramit Brahmavat of Veracity says a correction is expected in the equity market today, and in anticipation of the same, the rupee may trade with a flat to negative bias. He expects the spot dollar INR to trade in a range of 65 to 65.50. That's the range he talks about. And Ajay Magnolia of Edelweiss says the bond markets are expected to continue with a negative bias amid subdued participation. He says there are no major triggers lined up till next week's inflation release, and yields will track global markets, US Treasury yields in particular. He says the 10-year benchmark bond yield is likely to trade in a range of 7.72 to 7.77% today.
Okay, then let's talk about the negative news for the bulls. Here's Nigel with the world view.
Well, global markets, they have been trumped in the last couple of trading sessions. If you just take a look at it, from the time we closed up on Thursday, the Dow effectively is down nearly around 490 points. Yes, in Friday's trading session, it did see a bit of a reversal from the low point of the day, and a couple of those indices ended in the green. What's troubling them? Well, Donald Trump has been on the go, really. He's been tweeting non-stop. He's talking about making America great again, and a couple of measures that he intends to implement. One being the protection to steel. He's talking about a 25% duty on steel imports, and in terms of aluminium, 10% is what he's talking about in terms of steel imports. One place that did do well was the S&P 500. Why was that? The healthcare sector did well because that's one sector that may not get impacted even by this trade wars. The stocks that were under pressure were all the users. General Motors, Boeing, you had Harley-Davidson, all of them were under pressure. In the last couple of days, they've lost between 3 to around 5%. Even US Steel, that'll be a beneficiary, that did gain in Thursday's trading session, but in Friday's trading session, it did end with a bit of a cut. A couple of weak results as well further dampened sentiments because a couple of retailers, they disappointed in terms of their numbers. European markets, well, they were under pressure in Friday's trading session. And early this morning, there's talk of, in fact, the exit polls in Italy indicating a hung poll. So I'll keep an eye out on the euro dollar more than, in fact, the Italian index that, as it is, was down. Asian markets are under pressure today. Remember the Kospi at 6 a.m. our time, it was trading in the green. From there it's U-turned, and all those markets are trading in the red. That would mean the Nifty will start off in the red because the SGX Nifty is indicating a start at around 10,400, but you have to compare that with the Nifty futures. That would mean a 60 to around 70 point downtick. Back to you.
Okay, in fact, now 10,332 on the SGX Nifty. So from the high point, it's once again slipped because on Thursday, on Friday low point, it was 10,290 thereabout. Okay. So you have to compare with the level. The Nifty futures closing level was 10,450. So as of now, SGX Nifty is indicating about a 120 point gap down.
Okay. Well, let's watch. We just have about 40 minutes for the markets to tell us where they might open. But before that, let's parse all the developments, especially the big story this morning. The US likely to impose import hikes on steel and aluminum. Jeffrey Dennis, the head Global Emerging Market Strategy at UBS, and Ken Peng, Asia Pacific Investment Strategist at Citi Private Bank, join us. Good evening to Jeff and good morning to Ken. Thank you very much indeed for joining us. Well, Ken, first to come to you. Do you think now this is going to be a retaliatory war, and people will actually start having to reduce their estimates of global corporate earnings as well?
Well, I think first of all we'll have to see whether this goes beyond steel and aluminum, because just at the current stage, steel and aluminum accounts for such a small share of global trade, particularly with China, that if it stops here, it wouldn't matter that much. However, what I do see as a major risk is how Trump goes, well, how the U.S. administration goes ahead with the investigation over intellectual property, which could apply to a much wider, set of products, and also how the U.S. administration is going to improve its ties with Taiwan, which kind of becomes a bit of a deal breaker for China, and then negotiations go beyond the economics. So those are the two major risks that I see, and we'll be watching this MPC this week to see if we can get more signals on that.
Okay, Jeffrey, good evening to you. Of course, with Donald Trump, you always show that something or the other could come up over the weekend. But your thoughts on how equity markets, and especially emerging markets and the ones which export a lot to US, would react to this latest bit of rhetoric from the US president?
Well, certainly, I very much agree with Ken, actually, that I think the direct impact of these potential, which I think are still potential, by the way, they've not been confirmed, tariffs on steel and aluminium, they're important for a number of countries, but they are not that important if the biggest potential flashpoint in terms of trade conflict is between the U.S. and China. So within the emerging market space, they're very important for Korea, for Brazil, for Mexico, and of course in the developed market space for Canada. So one of the fallouts from all of this, so to speak, is going to be what it means for the NAFTA trade negotiations, which are, of course, at a still fairly delicate stage. So at this point, we're not inclined to start slashing our global growth forecast or anything of that sort. But we have to see how this develops, because this is a risk to the bull market that we're still supporters of. Because if this does escalate into serious world trade conflict, and some countries will retaliate against these tariffs, well, then that does pose a threat. I don't think China's going to react that much to this, however, and as Ken also said, we completely agree on this as well. I think it's how the U.S. government decides on this whole intellectual property issue. That's a much, much more damaging potential development for U.S.-China trade.
Okay. So you did say, Jeff, that you're not slashing your growth forecast just yet. That's good to hear. You spoke about the impact on emerging markets like Korea and Brazil. But is it fair to say that there's a minimal impact on a market like India? Because currently India accounts for just about 2% of steel exports to the US. So far as this news is concerned, is it fair to assume that hardly any impact is seen on our market?
Certainly one of the lesser impacted emerging markets in terms of some of the big markets anyway. But I think we have to be careful, because of course trade may appear to be a bilateral set of relationships, but of course it has multilateral impacts, because if what you get from here is significant retaliation and there is eventually a slowdown, a much slower outlook for the global economy, that's going to affect everything. But I think you're right, the direct impact of this on India is relatively small. And as I said earlier, there is extraordinarily on the Sunday talk shows here in the U.S. today the suggestion that we're not even 100% sure if these are actually going to be imposed. This seemed to be a very capricious policy announcement by President Trump, and we have to see what follow-through there will be, because the criticism internationally, again, indeed domestically, against these measures has been very strong indeed. So frankly, we just have to wait to see how this plays out.
Okay, Ken, in that case, would you say this is, since you say you'll have to wait and watch to see whether it becomes a full-blown war, would you at the moment use these dips to add on to your positions, pick up stocks you like? How do you look at this in terms of the bull market that has been on for the last 18 months?
Okay, look, I think first of all, I think the correction that we saw at the beginning of February was a good thing, because we're kind of in a process of normalizing from extraordinarily low volatility to something more normal. And that by itself does not really scare me that much, nor does higher interest rates, because that's supposed to come with higher growth. So based on that understanding, I would think that I'm still constructive on these markets. Even with this trade conflict, right? While we're waiting to see, I do want to highlight that China and to some extent emerging markets overall are less sensitive to these type of things, because they've built up bigger domestic demands. They've built up bigger, more resilience in terms of innovation and all that good stuff. So I think the net. Had this happened, say, 3 years ago, it will scare me a bit more than where we are now. Yeah.
Okay, Jeffrey, I had one more follow-up for you. Since you're talking about India, we have seen the Indian markets underperform over the last 2 months. There's been this added issue of this big bank fraud in India. Your thoughts? And we've seen aggressive selling by foreigners. Your thoughts on whether India right now is not among the top markets in pecking order?
It's certainly not amongst one of our top markets in terms of pecking order at the moment. I think I probably mentioned this on the program once or twice before. Earlier in the year, we actually turned more cautious on India at the start of the year. We downgraded it to neutral, and that was really because of valuations last year, which rose last year, even against the background where the earnings numbers were very poor. The market was up strongly. Of course, the contributors to the higher valuations, the foreigners were selling. The locals were buying, in particular, obviously taking money out of the property market. So we just think the market is just too expensive right now. It's got even more expensive against its global peers. The earnings outlook is somewhat mixed. And I think the bank fraud case, which I'm not really particularly up to date with all of the details of it, I think simply adds to the argument that one has to be a bit cautious about India at the moment. I still think it's a wonderful long-term story, and we think growth will improve in the next fiscal year to back towards the 7.5% range in fiscal 19. But frankly, at the moment, risk-reward in India is not as attractive in our view as it is in several other markets around the world.
Okay. Ken, before we end the discussion, I just wanted you to come in on the point that Jeff was making a while back about the possibility of these tariffs not getting imposed at all because of the kind of resistance that it's facing.
I think we'll probably get something. I think that the U.S. administration is a little bit more confident now in terms of pushing its agenda after the tax cut succeeded, and after I think the North Korean issue has kind of subsided. So I think as a negotiation strategy, it needs to deliver something on as a bit of a punch here. But the way this is done across the board on steel and aluminum, it seems to be angering too many people. So we'll see how the pushback is from Canada and the EU, as much as from China. So I think this it's interesting, but I think we'll probably get some tariffs in the end. Yeah.
Well, just your last overall comment on the global markets, Ken. This has pushed the dollar down. It was recovering to over 90 levels, but now the dollar index has again gone below 90. And as well, your pecking order now, which market would you prefer to put money in?
With regards to the dollar, I think it's the market's reflecting on the market's view that this is going to be more negative on the U.S. economy than it is positive, right? Because there's a lot more people involved in steel-using industries than steel-producing ones. In terms of the pecking order, we still like emerging markets the best because they do better. They tend to outperform. The equities outperform when the dollar is weaker, and that's actually fairly central to our overall view. And the economic cycle is not finished, and we will expect them to be benefiting from that, the remaining growth in this cycle. So within EM, we like Asia better, and think it's also China is probably higher in that pecking order compared to the others.